Credit card balances on the whole declined in June, and by the most in over 3 years. This wasn't the first time recently either. It was actually the second month out of the last three. Another critical economic signal strongly suggesting that momentum toward recession has been building up in the months before now. It's all about momentum. Once you get past the initial stage, just like the unemployment rate, there is a non-linear progression. In fact, credit card use is directly tied to unemployment. That's what's so critical about the data. It's not actually the direct impact on consumer spending. Consumers are basically telling us what they're perceiving about jobs and income by what they're actually doing. That's why there's a strong correlation between revolving credit and the unemployment rate. It's another cyclical signal that repeats in every recession cycle. And that's not the only one recently either. Just last week, lost in the middle of all that unemployment-inspired financial volatility, Census reported a decline in non-residential construction. Like consumer credit, that's a cyclical signal and not for any direct impact on the economy either. Rather, this one tells us what employers are doing. And if they're cutting back on capital expenditures, they're very likely to be cutting back on labor too. So these signals and a whole lot of others are validating the momentum of the unemployment rate. And there's more. Airbnb just said consumers are cutting back on travel and vacations, and then their stock crashed because of it. Delta, Southwest Airlines, both of those warned demand just wasn't there for the all-important summer season. Instead, summertime this year is the time for recession. And while everybody will swung all the way to the other side onto recession fears inspired by the unemployment rate and jobless claims and payrolls, and everybody this week is swinging back to the other side saying, oh, it was all an overreaction, momentum in the real economy is all on the wrong side, including consumer credit cards. So let's start with credit card data and what it actually shows us. Because as I said just a minute ago, it's not actually about the direct impact on consumer spending. It's what consumers are telling us by either using their credit cards or not using their credit cards. And when they're not using their credit cards, it's usually because they're afraid of jobs, incomes, and unemployment. Consumers tend to use less credit when they see softening in the labor market, which makes perfect sense. I mean, high-risk borrowers, they can't get more credit even though they want it because banks won't extend it to them. Banks tighten up with bad fundamentals. And other borrowers who may be able to get more credit are less inclined to use it as a measure of prudence. Not only do they borrow less, they even pay down their debts when jobs and incomes are uncertain. So usage of credit cards tells us what consumers are seeing in the labor market, and it's a momentum signal just like the unemployment rate. That's why these two fit so closely together. When unemployment is rising, people put away their credit cards, either voluntarily or involuntarily in the case of banks tightening credit standards. So we see a very strong correlation between revolving credit usage and the unemployment rate. And this happens in every single cycle. And you can see it very clearly in a couple different ways, either the year-over-year change in revolving consumer credit or the 4-month change by dollar value, which is a very strong correlation, especially since the 1980s. The recent data for 2024, June of 2024, the Federal Reserve reported a $1.7 billion decline in the seasonally adjusted aggregate balance of revolving credit. That's on the month. And that followed a $6.8 billion increase in May, but a $1.1 billion decline in April. And March was weak too, at just plus $2 billion. So that gives us a 4-month average of only $1.5 billion. And you look at the trend in the 4-month change in the 4-month average, it's very clearly, like the unemployment rate, suggesting that we got to the nonlinear part of the recession economy. Year over year, the change was 6.1%, which is down from 6.8% just a month ago. And it had been 8.8% back in December and even 11.1% last June. But while 6.1% year over year sounds like a substantial increase in consumer credit, it's mostly backloaded in the front part of that comparison. Again, the 4-month change suggests that the weakness is more recent. But even the 6.1% number is very much consistent with past cycles. In July of 2008, The year-over-year change in revolving consumer credit then was 6.3%, very close to what we see now. And the 4-month change in the monthly number was 397 million. So they were just starting to see a couple monthly negatives. Even though the year-over-year change was 6% and positive, the direction of that change was clearly lower. It was lower in tandem with the rising unemployment rate. So overall, consumer credit, revolving consumer credit is right now in the same general territory as the middle of 2008, the first part of the Great Not Recession. And we go back to further cycles, go back to 2001, the dot-com recession. In September 2001, revolving consumer credit was growing at a 6.8% year-over-year rate, with most of that increase in the front part of that period. The most recent 4 months, up to and including September 2001, revolving consumer credit, the seasonally adjusted monthly total, had declined by 581 million. So just like these last two cycles in 2024 as well as 2008, in 2001, the year-over-year change is above 6%, but the more recent change in consumer credit was beginning to fall off, following the unemployment rate as it rose. This is a consistent cyclical signal that tells us when consumers are afraid for their jobs and their incomes and their hours and everything else about the labor market. It's not what they say, it's what they're actually doing. And while it does have a direct impact, some direct impact on consumer spending, more important is what this validates about momentum as far as the labor market and the economy. And consumers in 2024, they're telling us it's recession time. Another one of those signals from the opposite side of the spectrum or the perspective, from the employer side of the perspective, construction spending. Construction spending, especially non-residential construction spending, it tells us what employers or businesses are thinking about as far as general business conditions. When they're more optimistic, they're going to be building more things. When they're less optimistic, they're going to be building less things. And when they're less optimistic and building less things, they're going to be hiring fewer people and maybe even cutting back their hours, as well as, in more extreme cases, actually letting go. They're going to be controlling their labor costs, which is absolutely consistent with the idea of recession. And last week, while everything else was going on, everybody was focused on the payroll report, jobless claims, and JOLTS and things like that, Census Bureau quietly reported a decline, actually a second straight decline in total construction spending for both May as well as June. And that is a cyclical signal all its own as well. It's the first time since August through October of 2022 that total construction had been declining. But residential construction was down, but really private non-residential construction. We got the fourth decline out of the last 5 months, going all the way back to February. And the fifth month, by the way, that was just barely positive at 0.1%. So basically 5 straight months of moderate declines in non-residential construction spending, which is a capital expenditure. So businesses right here are telling you that momentum is building on the wrong side. They're controlling their costs as far as capital expenditures and outlays. And if they're doing that, they're likely doing the same thing on the labor side. They're hiring fewer workers, they're cutting back in their hours, they're doing all of the things that consumers themselves are perceiving when they're not using their credit cards. Consistent cyclical signals, and this is before we even get to the last couple months of an unemployment rate that now everybody is focused on and everybody's paying attention to. And one reason everybody's paying attention to the unemployment rate is the Sahm rule nonsense. I mean, you don't really need a Sahm rule. And the Sahm rule itself is not a real-time indicator, even though that's in the name. It's actually a lagging indicator. It sure is not a forecasting tool. What the Sahm rule actually tells us, because of the way it's set up, is momentum in the unemployment rate. What it basically says is that momentum has swung in the wrong direction, that the unemployment rate is beginning to rise more quickly, and when it rises more quickly, it's most likely to continue on in that direction. It's another way of describing what I did in a recent video, the non-linearity of unemployment. Unemployment goes up a little bit, it meanders a little bit higher, and then seemingly out of nowhere, it just starts to surge. And the Sahm rule is a way to measure that point at which it begins to surge. And by the time the Sahm rule gets triggered, you're already into that surging part. That's what the consumer credit numbers are spending. That's what construction spending is telling us. That's what the bull steepening on the yield curve. And now the Sahm rule tells us the same thing. But as I mentioned in the introduction, last week everybody was all afraid of a recession, and this week it's all okay, nothing to see here, everything's just fine. And even CNBC trotted out Claudia Sahm herself to say, well, I don't see a recession, even though my rule, which isn't really her, she took it from somebody else, even though the Claudia Sahm rule says we're in a recession. It's not a forecasting tool, it's actually a lagging tool. Claudia says, nope, we're not in recession. What she told CNBC was, we are not in recession now, contrary to the historical signal from the Sahm rule, but the momentum is in that direction. And momentum is all that really matters. So she either doesn't realize it or she's specifically downplaying what's happening here. She continued, a recession is not inevitable, and this is the big thing too, there is substantial scope to reduce interest rates. And we'll get back to that in just a minute. Back to Sahm here. What is very worrisome, and today's employment report underscored it, is the direction of travel. The momentum is not good. Momentum is everything at this point. We are pointed toward what would be recessionary dynamics, and that should be a real wake-up call. And that's exactly what we're seeing in these other signals. Today, it's consumer credit for just through June, already suggesting that the unemployment situation had already built up enough momentum that it has turned. Construction spending, the same thing from the perspective of employers. So we agree with Sahm here that the issue is all about momentum, but she's downplaying that as a risk because, and yet, she continued, they have what is so important and a cause for being somewhat optimistic. The Fed has a big lever still to pull. They have a lot of interest rate cuts that they could go through if they need to. Oh boy. Fed rate cuts do not matter. But to economists, they are everything because they have to be everything. They get interest rates all wrong. They get them all backwards. The Fed doesn't cut rates to stop a recession. It cuts rates as a response to one. And it's a response to one that we see clearly in consumer credit, the bull steepening on the yield curve, and on and on and on again. As I've been saying all year, the weight of evidence has shifted from one side to the other. It's all now very decisively on the side of recession. The momentum has shifted in the evidence as well as in the real economy. But they're going to continue to tell us the Federal Reserve is our savior, even though history also conclusively 100% shows rate cuts do not stop a recession. Once a recession begins, once we get to that nonlinear part, once we see all the evidence that shows that, the Fed isn't going to be able to stop it. The Fed is going to chase the unemployment rate as it goes up. And that's what's so important about the credit statistics and all these others. It tells us that very likely the unemployment rate has already hit that point. Unemployment in the real economy has already hit that point where it's going to go up and continue to go up. And as it goes up, the Fed is going to take rates down, which the market already knows, and it's not going to be able to stop the recessionary processes. As if all that wasn't enough already, and to some people it will never be enough until it's absolutely perfectly 1000% clear and the NBER officially declares a recession. In addition to consumers not spending on their credit cards, one of the things they're not spending on their credit cards is travel and leisure, which is a big one. Because travel and leisure has been a big part of the economy over the last couple of years. Coming out of the pandemic, everybody wanted to travel. Everybody wanted to do leisurely type things. And they still really do. The problem is what changed this year versus last year and the year before is employment, the jobs market, income fears. That is preventing people from acting on those impulses. It's not just in the credit card data. Airbnb this week. According to CNBC, Airbnb shares dropped 14% in after-hours trading after the company reported second quarter earnings that missed analysts' expectations and warned that it's seeing signs of slowing demand from U.S. consumers. What they really said is that we're not seeing a lot of short-term vacation rentals because consumers are really struggling. Which is exactly what Southwest Airlines said back on July 25th, so just a couple weeks ago. From CNBC again, Southwest Airlines on Thursday forecast a potential drop in unit revenue for the third quarter as an oversupplied U.S. market has forced airlines to discount tickets during what is usually the most lucrative period during the year. When they say oversupplied U.S. market, what they really mean is that airlines bought into strong and resilient. Airlines bought into not just a soft landing, but the second half rebound and raised capacity anticipating demand would still be there. What they found out instead was that while demand was supposed to go like this, it actually went like this. And now they're in a situation where they have to cut prices to use all that to fill that capacity. Cut prices. Exactly the thing that we see in the CPI. Weakness in the core CPI that I talked about just yesterday, this is very much a part of it. It's a macroeconomic fundamental of a weakening demand consistent with momentum building toward recession, a disinflationary recession, if not worse. And they're not the only ones either. Back on July 11th, the day of the CPI, the day that the markets began to turn and reprice all this risk, Delta Airlines came out and said the same thing that Southwest did. Delta Airlines warned that domestic carriers are struggling to fill planes in the all-important summer travel season. Summertime is the time for recession, dragging down ticket prices in a fare war that's weighing on profits. It's weighing on the economy, it's weighing on profits, it's weighing on consumer price measures in a way that, as I mentioned, we have rarely seen before, especially for something like the core CPI. And airline tickets are a big part of the reason why the core CPI had decelerated as much as it did. And this suggests that it's only going to continue both the disinflation and the momentum toward recession that it embodies. The airline offered the grim assessment Thursday. This was back on July 11th, as it reported worse than expected financial results and a weak outlook for the rest of the current period. Excess supply has led to heavy discounting. Delta chief executive Ed Bastian said in an interview, like everyone, you get impacted. And Bloomberg reports that ticket price cuts have been particularly acute for June through August, summertime. So weakness in the economy, weakness in spending, weakness in credit card usage, all of it, momentum is building and building and building. And Claudia Sahm's rule shows that the momentum has already passed that point of no return. So we don't really need Claudia Sahm or her rule. Momentum has been building in this direction all this time. As I've been pointing out all year, the data and evidence continues to move in that direction. And it still is moving in that direction as we get more corporate warnings. We get more cyclical signals from the data, like consumer credit, which is a very strong one, very highly correlated to unemployment, and all of it suggesting momentum for recession has reached that critical threshold. And in response to the economy reaching that critical threshold and momentum having built already, we're supposed to believe that the Fed cutting rates is somehow going to save us. How is the Fed cutting rates going to save us when market rates have already moved lower? None of it makes any sense because it's not supposed to make any sense. Instead, what we're seeing is exactly what has been priced out all this time. And that is that the economy is in trouble and momentum is all on the wrong side. Given all that, I started to look ahead at what might be coming next in the video linked below, talking about 3 different market signals and what they might tell us about the near-term future. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.